Every week in the proprietary trading industry, thousands of users risk their own capital to buy evaluation accounts. And almost entirely, they make those purchasing decisions by looking at one thing: headline star ratings. A 5-star rating is not automatic proof of safety, just as a negative review is not undeniable proof of a scam. This week, Trustpilot applied breach of guideline warnings to multiple major prop firms, calling the reliability of their public scores into question. 14 companies were identified in the monitoring sweep, including industry mainstays like E8 Markets and the Trading Pit. A platform-confirmed warning indicates Trustpilot intervened directly to remove reviews they flagged as fake from these specific profiles. To be precise, this purge does not confirm that every positive review is fabricated, nor does it establish that these firms have mistreated their active traders. It does, however, mean headline scores can no longer be used as a primary metric for quality. Traders must instead look toward independently documented payout policies and rule structures. This evidentiary approach is necessary when technology fails, as seen in the mid-August infrastructure disruption affecting Lucid Trading. Multiple independent traders reported issues tied to a Rithmic and TradeSea outage. These reports describe an inability to close positions and unexpected market executions that led to account breaches. One case from Sweden involved a trader who alleged the outage prevented him from exiting a trade, resulting in the total loss of his account. A secondary report from Brazil highlighted a specific mathematical discrepancy. A leader account logged a loss of approximately $203, while 3 connected follower accounts showed profits of $27 each for the same activity. A third allegation detailed a ghost trade that reportedly appeared during the outage, wiping out 15 days of trading work. While the infrastructure failure is a matter of record, we cannot verify that every claimed account loss resulted directly from the glitch. In these scenarios, the burden is on the trader to demand account-specific forensic evidence from the firm rather than assuming a general refund is owed. Moving from technical failures to direct financial disputes, we identified the largest individual payout claim in this week's data. A trader alleged that E8 Markets denied 2 separate payout requests, one for $40,000 and another for $54,200. This brings the total disputed amount to over $94,000. The review making this claim was marked as verified by the platform, confirming it was posted by a registered user. A verified reviewer status does not establish that the firm legally owes the amount claimed. To validate a claim of this scale, we require proprietary data: the full trading logs, the signed account agreement, and the specific risk review findings cited by the firm. Massive financial allegations often shift public perception quickly, but they do not prove systemic risk unless the underlying compliance evidence is also examined. Our monitoring also covers specific rule enforcement patterns across the broader industry. The Trading Pit recently rejected a $12,000 payout on the grounds of non-independent trading. The trader attempted to contest this by submitting video analysis and handwritten journals. The firm maintained its decision, citing internal risk assessment criteria that are not disclosed to the public. At FXIFY, several traders reported payout rejections based on latency arbitrage. While the traders deny using these tactics, FXIFY maintains that its risk department has identified prohibited activity in these accounts. FundingPips is seeing a cluster of complaints related to device ID and IP network associations. Users claim these flags are triggered by shared household networks or previous owners of the devices, rather than intentional account sharing. Finally, NYS Markets showed a 55% concentration of negative feedback, largely involving disputes over news trading breaches and maximum risk calculations. A pattern of highly specific technical complaints across multiple users is often a more reliable signal of firm risk than a single large dispute. To balance these findings, we also look for positive evidence, which was observed this week at My Funded Futures. With a very low share of negative reports, users documented successful payouts arriving within an hour of completing their paperwork. This highlights our core principle: both traders and firms deserve the opportunity to supply exact rules and account-specific evidence. A flawless review score does not guarantee how you will be treated, and a payout certificate is not proof of future performance. Safety depends on stripping away the emotion, independently weighing documented facts, and choosing to relentlessly follow the evidence.